Hey everybody, I'm here with Zach. He is a venture capitalist out of San Francisco, an early stage investor, and really big on helping early entrepreneurs get started on their journey. Welcome and thank you for being on the show.
Yeah, good to be here.
Love to hear your entrepreneurial journey and how that led to you getting into the VC side of things.
Yeah, I like to joke that I've never had a real job. I've been an entrepreneur my whole life. Started when I was 16 and spent 20 years throwing myself against the wall, getting the shit kicked out of me. About the last one was Trigit, which was an ad tech company. We were one of the very early sort of players in the programmatic space. And we grew that to about 30 million in revenue and then sold it in 2015. Kind of a crazy exit. Facebook gutted us. So we literally were on fire until Facebook decided that they wanted what we had and went through a very, very painful period. But yeah, and then at that point, I like to joke that I became a washed up entrepreneur, but I washed up on the beach that is being a VC, and the beer is cold and the living is much easier than working for a living. So I've been doing this for now the last 5 years. And it's going well.
What was your first company when you were 16 that you started?
Yeah, so I started a business at the Olympics. We ended up taking it to 5 different Olympics, and started originally in pin trading, and then it sort of quickly grew to collectibles and tickets and, just basically going to the Olympics and hustling. But, as a kid making, a couple $1,000s a day and being able to go see, everything at the Olympics was a really fun experience. And it opened up my eyes to how much better it is to sort of control your own destiny than to work for a living. And I've never gone back.
I kind of feel the same way. I started my first company when I was 17 years old. Mine was a landscaping business. And I just remember the contrast of, like you said, making $1,000 in a day. For me, it was working outside with my friends and doing what I wanted versus like being a busboy and making maybe $1,000 in a month. It just was like, well, this is a much better way to live and interact with the world. You and I connected, I think, originally on Clubhouse, and then I follow you on Twitter. I feel like you're a very thoughtful, contrarian thinker. And what it seems like you're really good at is thinking about second order consequences, where like a lot of the things you're discussing is not the immediate policy is today, but how that policy might affect second or third order consequences. What makes you think about that in such a manner?
Yeah, I mean, I think that's always fraught with danger, right? Because, it's a lot easier to think about sort of cause and effect than it is to sort of think about systems. And especially the sort of like the consequences of changes that, are difficult to discern from what is, bullshit and an imagination and or bias or, all the uncertainty that happens once you start thinking about things multiple steps down the road. But I think, I'll go back to sort of the Olympics business. One of the things that I learned very early was, the Olympics are like a system. You show up at a city, let's say it's Athens in 2004. Yeah, it must have been 2004. Yeah. And, the way that Olympics worked was totally different than Sydney. And that system has, a large number of players and has a very complicated dynamic of sort of like competitors, market, customers, opportunity sets, like all these different dynamics that are kind of constantly playing with each other in ways that really require understanding where you make the money. Because in the simplest sort of way, you can show up at an Olympics and say, oh, I'm going to go make my money doing this, and then realize that that's actually a terrible way to make money and all the money can be made over here doing this. Or you get over there and then you're like, oh, well, this is the right way to make money, but I need to do it in a different way. And so you really have to be adaptive in a way. And I think that from a very early age taught me that sort of looking at these complicated sort of interweavings of dynamics is really the way to figure things out. And so I really enjoy that process. I can't claim I'm that good at it. Like, it's a hard thing, but I like it. So I keep trying to do it anyway.
It seems like that's the same thing that you would have with the ad tech space, right? Where, it's kind of an 80-20 game. If you understand the systems that coincide with this, there are certain ways that you can generate a lot of revenue, and there are a lot of ways to not generate hardly any revenue at all and a lot of viewership.
Yeah. I mean, I think ad tech is a good example, right? So, like, you can think about the dynamic in ad tech as let's break it down into three. Like we could break it down into 300, but three I think makes it simpler. You have sort of core value, which is at the end of the day in a sort of optimal advertising ecosystem, you have advertisers are able to show the right messages to the right people at the right time that lead to those people responding to those messages and buying stuff. Like that's at the core, it's like, I need a hotel in Sao Paulo, April 5th to April 9th. And if Booking puts an ad in front of me saying, hey, here's a great deal on a great hotel where you want it to be, I'll be like, click buy. And so you've got that's the sort of core value proposition in ad tech. And in order to attack the ad tech market, sort of first principle thinking is like, how do I deliver value? And that sometimes it's very difficult, sometimes it's very easy. Like there's a lot of different moving pieces in there, but there's the value delivery is sort of the first sort of thing you have to figure out how to do. But the second part of the game, which I think is really where it gets really interesting, is thinking about the dynamic that is the competitive marketplace. And so you have right now this sort of duopoly that's formed with Google and Facebook largely controlling the most of the advertising online. And that duopoly had a whole bunch of different consequences that led to those of us, like I like to think about it like, like they're big battleships, and those of us who are startups are like little speedboats. And like, yeah, you can turn faster than them, but if a big battleship is going to run you over or decides to shoot at you, you're dead. So you have to really be really aware of where those battleships are and how they're operating in your strategic landscape so that you're in a position to be able to not get killed. And then I think the most interesting thing, the third order effect, and I think one of the things that we learned, in retrospect, is that a lot of the money that gets made in these venture businesses are at the very end of the growth curve. So you go from, 10 million in valuation to 30 million in valuation to $300 million in valuation to 3 billion to 30 billion. That jump between 3 to 30 that's a huge amount of money that gets generated. And so you look at like a company like the Trade Desk, and they were a peer of ours. Jeff Green started this company at the same time that we did. We were all competing to be like one of the players to do what they did. And he was able to recognize a path that enabled him to not only avoid the battleships, not only deliver value to his customers, but also to be in a position to be big and to stand alone and be that $30 billion business. And so like the real value is all in that third step, but you have to figure out from a sequencing and from an execution perspective how to execute those first two steps to even get to that third step. But you have to be thoughtful about the third step while you're executing the first two, or you end up in a trap, which a lot of people in ad tech ran into, where they built a lot of value, they didn't get killed, but they ended up in basically a kind of a crappy little hole where they made, they made good money, but they didn't make $30 billion of good money.
Yeah, I mean, I think that makes a lot of sense. When you look at the asymmetric upside, it really comes in at, the end of the curve. It seems like that thought process from a game theory standpoint drives a lot of the valuations, right? So if you invest in a company that's going to be worth $30 billion, it really doesn't matter that much if you invest at a seed round valuation of 5 million or 50. The thing that really matters is getting in if you think that company has the ability to get to the $30 billion valuation.
Yeah. I think logically that makes sense, but from a practice perspective, I don't really understand how to do that. And I think the best way that I could articulate that is, so if you think about like a company that's at a growth stage, so it's, they're generating revenue, they're growing really rapidly, and you can sit down and look at them and be like, okay, I think they're going to be a $30 billion business. And there's a relatively small number of companies that are sort of at any stage that could basically fit that parameter. Then you have to get into the business. And so getting into the business basically requires this, intense competition with a whole bunch of other smarter people who are basically thinking the same thing. And everyone in that business is effectively handicapping and underwriting that risk of, okay, what's the risk that they can achieve the $30 billion outcome to the best of my ability to figure that out? And what's the sort of probability of all these other outcomes? And how do I model that out? And so you see that like a whole bunch of relatively smart people arrive at relatively similar sort of valuations because they're all kind of operating in the same context. They're looking at the same public market caps. They're looking at they all kind of end in coming in like a relatively tight band in terms of valuation. And whenever you see people who come to the market and they operate outside of that band, they blow up all the time. Like it's very difficult to be that much smarter than everyone else that you can afford to pay that much more and still basically be successful. And so it seems easier to do that late stage stuff, but in a lot of ways for me it's harder because the competition at the late stage, everybody has the same amount of data, so the band gets tighter. Whereas at the early stage for me, there's just so many more variables and there's so much sort of imagination and so much pattern recognition that's happening that I don't lose deals because someone bids more than me. Like I lose deals because I didn't move with enough conviction. I didn't move fast enough to put my bid on the table, but I never lose deals because someone's bidding higher. And so it's not a very good answer. It's kind of like muddy, but it's just a very different problem. But I haven't figured out that later stage. Like it seems easier, but it doesn't seem easier to me.
No, I mean, and I think that it seems like you're good from what I can see at what you do. You understand the space, and what's interesting is when I look at your portfolio, you've got a pretty diverse portfolio set. I mean, you've got some prop tech under your belt. You've got some like self-driving automation. I think it was acquired by Cruise. Looking at aggregator of barbershops and like different. So, and then you've got like a mud water coffee brand under your belt. So I like looked at it, I was like, this is pretty interesting. I mean, I know you cut checks between $200K and $1 million, and you go B to B or B to B to C, depending on how I'm supposed to say that. But I looked through your deck, and I was like, there's some really cool stuff. Like, the thing that stood out to me was like your dragon fruit company, where I was like, with COVID going on, that's going to be such a high desire thing. Like I used to own a co-working space, so I used to be in the prop tech world. We were worth like 35 million, and then we were bankrupt in like 3 months because of COVID. So it was like, I mean, just
that's painful.
It is. It was like you spent 5 years on something, and we were like top startups in New York City. We were well funded. We were profitable. Like everything was going well, and then it was just like, well, like that didn't work, and but that's the way it works when you're an entrepreneur. Sometimes you're the hammer, sometimes you're the nail, and that's just how it goes. You've got this really divergent set of companies. Are there any ones that you're more excited about or less? I know you've got like a competitor, DocuSign, I think it's called HelloSign, that you have under your portfolio. Are you just more founder focused, and that's kind of what you bet on is the jockey, not the horse type deal?
Yeah. So I like to think of it slightly differently than sort of most folks. I like to break it. I do everything by threes. So I like to break it into three sort of things. One is there are founders who like I've known for a long time and they're really capable. I've seen them operate before, and they're smart and they're good, and oftentimes for those I'm really comfortable betting on whatever they're doing, with exceptions. But but there's only so many of those. Like I just, if Kyle from Cruise calls me up, it's like, Zach, I'm raising money. I'm like, how much do I write when? Right? It's like, the most interesting things that those folks do are usually the things that seem craziest. And so it's kind of a crazy founder bet. But I don't have enough of those in my sort of network to like just do that all day long. And so the second category where I spend a lot of time is there's a moment in a startup's experience. And the way I like to frame it is like, a startup will go into the forest basically trying to find product market fit. They have an idea. They're like, oh, we see that mountain over there. We think there's a gold mine over there. Let's walk through the forest. Let's walk up the mountain and let's try to find the gold mine. Build this company. And, you walk into that forest, you bring as many resources as you can. You've raised money, you've hired a team, whatever you got. Sometimes it's just you, sometimes it's a whole crew of people. You got what you got. You go into that forest and you make contact with the market, you make contact with your customers. And you very quickly realize that like the things you thought were true are not true. They may be true, they may not be true, but and the world is very different once you're in the middle of the fray, attempting to find product market fit. And a good founder at that point is really, really, really good at listening to what the market is telling them, what their customers are telling them, what sort of all the interplay that's happening around them is informing them where that opportunity is, where the gold is. And I find that there's a sweet spot, which is where I like to invest, which is in the beginning you talk to an investor or founder and they're like, oh, we can do this and this and this and this, and we can do this and because they're talking about the mountain that's 10 miles away and then they don't know what's going to happen over there, so they have a lot of ands. But there's a moment when they basically find it and then you ask them and they're like, oh, we do this. And then it's like, oh, because then there's a crystallization of value that they can call up a customer. I like to say, if you can't call up a customer at 9 o'clock at night while they're putting their kid to bed on their cell phone, tell them what you do in one sentence, and instead of having them say, fuck you, why are you calling me? Have them say, ooh, I want to talk to you tomorrow. Unless you can enunciate your value that cleanly, you're not there yet. You haven't found product market fit. And once you find that, you'll find that basically the business almost inverts. All the things that used to be easy, sort of your team and your office space, your HR policies, your servers, all that stuff that used to be easy because you didn't have any growth, suddenly become really hard because you're growing really fast. And all the things that used to be really hard, or actually, sorry, let me restate. I got it mixed up. The things that used to be hard, customers, revenue, traction, suddenly becomes really easy. And the things that used to be easy, all that other stuff, becomes really hard. And so that inversion is all about basically that crystallization of product market fit. And that's where I love to invest in that, because there's a magic moment right when that happens, when you can put in a lot of capital to work at a relatively reasonable price. And then about 6 months from then, as you start to see the month-over-month revenue growth or month-over-month customer growth, or as the metrics start to get long enough in the cycle that any VC can extend the line, suddenly the price just goes through the roof. I've seen it over and over and over again, where you invest in a business at, $5, $6, $7, $8, $9, $10 million, and then 6 months later it's 30, 40, 50, 60, 70, $80 million valuation. And that's not the fundamental change in the core business. It's not a multiple in revenue. It's the fundamental change in the trajectory of the business because they've discovered that product market fit. And suddenly everything gets really exciting in terms of, big fund VCs are very happy to write big checks because they can extend that line. And, if you got a high enough growth rate, you can still get really big.
It's the first time I've heard it explained that way. And I think that it's really intuitive and logical, right? You're seeing what the larger VCs are seeing 3 months ahead of them, right? And
in theory.
In theory, right? Your hypothesis is that you're seeing it earlier. And that's the whole thesis of all investing, is that you're able to identify an opportunity before the majority of people identify the opportunity. At the end of the day, and you're baking in your risk.
But I have a different risk profile than they do. I get head faked just like everybody else. I get into a business, I see that, and then I write the check, and then a month later they're like, oh, by the way, and I'm like, shit. Because it's a lot harder to by the way with 6 months of revenue growth or 6 months of metrics, because usually those things tend to basically continue in a much more significant way. But when it's a narrative, when it's a value crystallization, it's a lot more easy to sort of So then that really comes down to sort of understanding when the entrepreneurs are trying to basically snow me, and that's a constant part of my job, is how to suss out what's the truth and what's complete bullshit, which is okay. It's their job is to go sell a dream, to sell a vision, to sell the future, and my job is to try to figure out what's actually true.
It's a hard job, because what you said earlier is so correct. The best and the craziest or worst ideas sound really similar at the time. And I always kind of give the example, like, if I was a venture capitalist and the Airbnb team had pitched me on Airbnb, I would have passed on it 100 times out of 100. And it's an amazing company. I love it. I've used them. I think they're an amazing company. But if you had told me when that had the inception that people will open up their houses to strangers, I would have never got that. It's just, it's really interesting to me to think about that.
Yeah, I think that's one of the most interesting parts about the job is I like to think about it like a yin and yang. Like on one side you have the analysis, you have the diligence, you're really trying to figure out where truth is. But on the other side of it, you have imagination. You have to basically connect dots that are not dots. They're little smudges of smoke and say, okay, I can see that and I can imagine that and I can see, and I think one of the really interesting things that I learned both with Airbnb and with Uber is the one sort of like, almost you can think about it like a mental breakdown that happens a lot in my job is you see what is clearly an obvious blocker and you're like, oh, well, obviously that won't work because of X. But then if you imagine getting past that blocker, then suddenly both of those ideas become incredibly exciting. So like, for instance, when Travis started Uber, he and I were at a party and, having a beer, standing on the deck, and we argued for a long time about whether or not it would work. And I was like, look, bro, like, it sounds amazing. I can push a button and a car shows up. That's amazing. We all want that. But, like, I don't think it's going to work because, like, the taxi lobby is really strong. They're corrupt as hell. These governments are, like, totally going to fuck you. Like, it's not going to work. And he was like, look, dude, I'm a fighter. I'll fight through this. Like, and it wasn't, like, that answer was not actually the answer in retrospect that turned out to be the right answer. But it was, if the right answer would have been, okay, on the other side of that barrier, the green field is so big in terms of the value that you can create for customers. It's so clean. It's so amazing. And if you think about the multiple against that value, in retrospect, it's, multiple thousands of X. Like, my friend Oren put in $5K and made $25 million. Like, that's a big jump. And in that scenario, if you, in retrospect, think about it that way, you're like, okay, this is one of these bets where if they make it, it's going to turn $5K into $25 million. You would literally just make those bets all day long, endlessly. Because you could be wrong 1,000 times in a row. It wouldn't matter. Because that 1,001th time, basically, woof, like, it just makes everything up. And so I think that's one of the most interesting things is our brains are not wired to think about exponential sort of things. But if and when you can find them, oh, man, it's insane.
There are two things I think our brains are relatively bad at. And one of them is conceptualizing exponential change and the size of the upside, whether you're looking at a seed round in Uber, whether you're looking at investing in Ethereum at 50 cents or, Bitcoin at $1. But the other thing I think our minds are really bad at is conceptualizing how long human existence has been and how short the time has been since we really started innovating. So like you started with like electricity in like the late 1800s. You hit your first retail computer, like a Mac, came out in like the 1980s. And then the internet had like 1 million people in 1994. So in like the past 17 years, or rough math, 20 years out of all of human existence, we have had like so much innovation. It's hard to wrap your head around how far we've come in 20 years.
Yeah, and how far we will go. Like that's the one thing I always want to remember is that, in relatively short order, certainly within the next couple decades, you'll never drive a car. We will solve the clean energy problem or we will be royally fucked. We basically will live in a world of VR that will seem real. So why would I get on a plane and fly to Europe when I can basically enter a 3D virtual world that feels like Europe? It smells like Europe. It is Europe. All of these technologies that are science fiction will be built. And in that, robots will largely do all the manual labor that we currently do. And so you look at that and you're like, okay, all those things will happen, but I think that's just a given. And the question is like, okay, how much work is there between here and there? Oh my God, there's a lot of work, but it's all going to happen. And so how you think about that and how you wrap your brain around, it's like super challenging, interesting problem.
Yeah, and I think it just goes back to having trouble conceptualizing like exponential change. There's this saying that like things that have never happened in the history of the world happen every day. There's so many new things that are happening. It's like, just thinking about that. So I've got a question. How did you get into investing in cruise automation? I would have thought most of the investors in that would have been huge in the AI algorithmic. Not that there aren't algorithms in ad tech, but how did you get into that one? It's a great play.
Yeah, I mean, so that one was really easy for me. I had just sold my company, and I was sort of like wandering around like a lost puppy, trying to figure out what to do with my life. I mean, I'd been a CEO for a decade, and that was my entire existence. And then suddenly I had nothing, and I was like, I mean, it was such a weird feeling. It's like I was so what's the right word here? I want to say crushed, but that's not the right word. But I was so beaten from that experience that like I didn't even really think clearly. It was a very weird stage in my life. And so AngelList had first started the AngelList syndicates back at the end of sort of 2014-ish. And one of the companies that I had been advising was a company called Branch Metrics, which is a mobile deep linking platform. So I'd introduced them to their seed investors. And then so this A happened, and I was like, hey, guys, do you mind if I, put up a syndicate, try to do this for, I don't know, $200K into the A. And they were like, sure, go for it. And, I wrote the little memo, and, 24 hours later, it was filled. And I was like, oh, look at that. I'm an investor now, which is, I'd always dreamed of being an investor, but, I'd always figured that I either needed to have my own capital or I needed to go, work at a VC firm to be in the position to write checks. And so AngelList really sort of like gave me the set of keys to a Ferrari that was just sitting on the street. They're like, hey, go drive that. And I was like, I can do that. And so Cruise was literally my next deal. And it was sort of like super happenstance. I mean, Kyle and I went to coffee because I tried to hire Kyle for like a decade because he's like literally one of the smartest people I know. And he was always like too smart to say yes. He's always like, no, fuck you. But he was working on Cruise, and they were just raising their A. And Spark, which was a VC firm that I was, deeply involved with because they were in my company. They were leading that round. And somehow Kyle came to believe that I could be helpful in building the company and helpful in understanding how to work with Spark. And maybe he just, felt sorry for me. I don't know. But he gave me an allocation in the round. But it really largely came down to personal relationships. And, thankfully I was, smart enough to realize that Kyle's awesome, and investing in awesome people is the easiest money you ever make. And I was like, yep, here you go. And 18 months later, we sold it for $1 billion. And suddenly everyone thought I knew what I was doing, and, a whole bunch of capital sloshed over. And that really just sort of like made my career. Very, very much like a lot of dumb luck, a lot of being in the right place at the right time. But it was very special. Very special.
That's an incredible story. You got gutted by Facebook, and you've put your soul into a company for 10 years, and probably didn't have the exit multiple that you've dreamed of. I don't know what your exit was like, but probably wasn't the multi-billion-dollar exit that you dreamed of. And to then hit it so big with such a big company, I think that's fantastic.
Dumb luck is amazing. I mean, it's the greatest thing about this business is that you can be really smart. But, if you look at, investing in tech over the last 20 years, it's not about being really smart. It's about basically just not being stupid and not getting over your skis and not sleeping with your coworkers or not doing dumb things, and just being in the business and just helping people and adding value and just getting all the amazing beta that is the technology sort of tidal wave that we're all in front of. I mean, it's crazy. Like in the last... So I've been in Silicon Valley now for a little over 16 years. I have well over a dozen friends who are now billionaires, who started as literally just my buddies. Like, we were all sitting at the poker table, and now here's Drew at Dropbox, a billionaire. The Airbnb guy's a billionaire. The Uber guy's a billionaire. Like, just like all these billionaires, like, could literally fill up more than a poker table, and they were just all just random. And hundreds of people who've made tens of millions of dollars. And, I look back at sort of like my peer set from Minnesota, and the delta is indescribable. And so that's not because I'm so smart that I made all these smart friends in Silicon Valley. It's just that there's so much value being created that the tide is not rising. It's just it's just racing. It's just like, whoo, and I don't feel like that's going to stop for a significant amount of time.
Do you think that San Francisco will keep that kind of lockdown because when I look at it, I'm like a numbers guy where I kind of like to think in game theory.
Yeah.
And from a statistical evaluation standpoint, you have such an asymmetric upside investing in early stage in like the SF grader area, where you look at the number of unicorns and it's just so outsized when you factor in like population, or when you don't factor in population size. Like, you know, I mean, you're number two in the U.S. if you speak English is New York, and you know, New York might have 10% the unicorns of San Francisco. So you think it will continue forward into the future with the same like robust nature after COVID?
I don't know. If you would have asked me 3-4 years ago, I would have been like, yeah, obviously. I mean, I think there's a bunch of sort of things happening that make me question that for the first time. I think one, the idiots who run our city, really the ideology of people in this city is so far off the realm of sort of like what works for growing and building businesses that they're destroying our city. I mean, the crime in the city, the trash in the city, the destruction of the living standard of the city is just really horrible. And everyone I know who looks around at it is like, oh my God, what the hell? Like, this is crazy. And, you know, unfortunately, what that means is like a lot of my friends are like, okay, I'm going to go move to Miami, or I'm going to go move to Austin, or I'm going to go move to Seattle, or I'm going to move to Jackson, or I'm going to move to like everywhere. And so you've had this amazing network that used to be concentrated here, and suddenly with work from home and from the way that they're destroying our city, those people are scattering, and it's unclear how many of them will come back. So that's I think the first step. The second step is that they also make it really difficult to grow a business. You know, you have a regulatory and sort of like political regime that is just like constantly making people's lives miserable if you're trying to grow and build a business. And so unfortunately what that means is a lot of these businesses now are all saying, look, we're no longer headquartered in San Francisco. We're work from home, or we're remote companies because we can't put up with this crap. And so a lot of those kids who came here to join as entry-level programmers 10 years ago that then went on to start big businesses now aren't even going to come here. They're going to be somewhere else, and they're never even going to make it in here because the rent's too expensive, because they won't let people build houses, and all these stupidities are kind of piling up on each other. And so, yeah, the density, the network density that is here is still the most intense in the world. All the people, most of them are still here, but that it's gone from basically a sort of like growing, like from a compounding to the inverse, where it's spitting off all of this talent to go to other places. And you know, will we get through that? Will we reemerge as sort of like as a place where people want to live, where it's not, we don't have to worry about getting mugged or walking down the street covered with needles? God, I hope so. I love this city. It's a great city, except for the fact that it's run by idiots. So.
Yeah, I mean, I was living in New York when I built my startup, and so I feel like New York and San Francisco have a lot of similarities with whether you're looking at cost of living. For me, you know, the reason why I moved to New York to start my previous co-working company is if you wanted to create an office space business, the best place in the United States objectively is New York City. But when I look at it and I say, well, you know, you think about an early entrepreneur, an early engineer, and they're making maybe $250,000 a year, and you're just kind of like getting by. You can't afford to buy a studio apartment with $250,000 a year salary. And then you contrast that with maybe Miami, maybe Austin, Texas, maybe Las Vegas, and you know, you would live like a queen or a king on $250,000 a year, and you know, your taxes are low. You know, in all three of those places, you have no state or local taxes. You can buy a home that's really, really nice for $500,000. And so I ask myself kind of the same question: do I think New York will kind of go back to being New York? And I hope yes, because I love the city as well. But it's the same constraints that you're seeing there. And what for me is scary is when people just say, no, we'll be fine. That's like the worst. That's the scariest answer for me, because I think it will be fine only if we pay really close attention and like address the issues.
Yeah, I think that work from home is like a regime change. I think like when you no longer need to have people in the office, you don't need everybody in the office. Like there's a lot of jobs where people can work from home. a lot of people will work from home. And, when you have a double-digit decrease in the number of people who are required to be in a city, that has so many cascading effects in terms of the amount of revenue that comes into a city, the restaurants that it can support, all of the cash that a city is required to operate in the way that cities operate. Like suddenly you start to see the opposite. It starts to decline. And I think a lot of people don't understand what a decline curve feels like and looks like. Because once you start down a decline curve, everyone who's on that curve, who's made investments in growth, suddenly freaks the fuck out. And they start selling, they start exiting, because decline curves are terrifying. And so you get this compounding effect of people leaving as soon as the decline curves happens. And so you don't have to look far back in American history, and you can look at basically major American cities, in the 70s and 80s. And I mean, God, New York, it was like a war zone. And that was, the same things that made us all so excited about basically living in the city 5 years ago were the same things that got people in the 50s and 60s excited about living in the cities. And the same things that's destroying our cities now are the things that destroyed the cities then, which is people got complacent, people got, they became convinced that, everything always just goes up. And they basically started electing politicians, and they started adopting policies that were representative of their beliefs rather than representative of pragmatic sort of answers to questions that work. Yeah.
And you don't have to be an in-depth historian to look even throughout the United States. Pittsburgh used to be the economic epicenter of the United States in the early 1900s, where you had Carnegie that was VC backed. So it was almost like a New York City meets Silicon Valley, the most millionaires per capita. A millionaire then would be a billionaire today. Yeah. And then it wasn't, right? Now Pittsburgh's part of the Rust Belt. and Pittsburgh has a lot of great things about it, and it's a good small to mid-sized city, but it went from a combination of New York and San Francisco to being that now is coming on a second resurgence. And you've got some great robotics, Argo AI is there, and you've got Carnegie Mellon, which is a great academic institution, but it's not in the dialogue of Miami, New York, San Francisco, Chicago, Boston area. And so those things do change. I wanted to ask you, you've got this investment in Booksy, right? Yeah, and it's kind of different than all of your other investments, but it's doing well. You're top 10,000 websites in the United States. How did you invest in that one? Because I looked at your portfolio, and it's a very cool mix that I could never come up with.
Yeah, I mean, the secret to sort of what I do is it's very much sort of you just wander around, and then eventually you run into people who are amazing. So the Booksy one is interesting. I was in I used to do some work with McKinsey as sort of an external advisor to them. They would fly me to Warsaw, and I would talk to some people about innovation or whatever, and they'd pay me too much money. And so we were there on an assignment, and we went out and we drank way too much the night before. I mean, I was fucking drunk. And the next morning they had scheduled a meeting for me with this guy. One of the McKinsey partners was like, "Hey, you should meet this founder. He's awesome." And I was like, "Oh, okay, fine." And so I had this breakfast meeting with Stefan, the founder. And, I went down to a, 8:30 meeting, and I was still not sober. And I sat down with this guy, and literally in less than 5 minutes, I was like, "Oh my God, I need to give this guy all my money." If you spend enough time around founders who really, I think at the end of the day, there's three things that you really need to look for. One, they know how to do what they need to do. And Stefan had already built a number of big companies. He just clearly knew not only how to do what he needed to do today, but I felt confident that he's going to be able to do it from here till the future. Two, they have an idea that's working. And so that's the crystallization, finding something that's starting to work. And Booksy at that point in time was working really well in Poland. They hadn't even come into the U.S. yet in a significant way. But it was clearly, it makes sense. At the end of the day, what all Booksy does is it provides software to hairdressers and nail salons. And the software enables them to make it really easy for their clients to schedule an appointment. So, if I need a haircut, which I kind of start to do, I just basically use Booksy and push the button, and boom, I have an appointment. I don't have to call anyone, I don't have to do anything. Just boom, and for them, I show up, and it's all super easy. But then the power of Booksy is you get this amazing network effect, which is the more hairdressers and nail salons they have, if I suddenly need to get my nails done, I don't, but let's say I did, I could be like, oh, I don't have a nail salon. Where do I go? Oh, appointment, boom. And suddenly you become this engine that drives those customers into a new provider. And then what you saw in Poland and now what you've seen everywhere in the world is the more you get, the bigger and faster they grow. And so you had this starting to take off, and it was super obvious. Like, it was like, oh my God, it's going to take off. And then the third thing is like, how big can it get? And, the great thing about beauty and beauty services is it's a giant market. So yeah, it was super easy. Like, I literally made the investment decision in, less than an hour. Unfortunately, back then I didn't have the sort of capital that I needed to like write a big check. Like, if I had $1 billion fund at that point, I would have been like, here, Stefan, here's $20 million. Please give me, 10% of your company, and then I'll just be like, we're good to go from here. So my check was much smaller than that. But yeah, I mean, it's a great business. It will be a multi-billion-dollar business because just that team is so smart. And you just look at their execution, you look at that curve, and you're like, it's almost a done deal as far as I'm concerned.
I was researching. The traction was incredible. I kind of went through your portfolio for the last day and was looking at it. I was like, this is an outlier. Like, this is something that's, you got some prop tech, because most of the stuff that you have is a higher level of efficiency across the board. Whether it's easier to drive, more efficient, getting a haircut more efficient, you're going to utilize office space utilization more efficient, sign a document more efficient. So that was kind of the commonality of the bonding that I saw across the portfolio if I was looking for like a common theme. But I was like, even across that common theme, this is pretty B2C, but it is B2B2C. But I thought that one really stood out to me. I was like, there had to be a good story behind it, I figured. But it's got huge traction, very successful from what I can see.
Yeah, I mean, I think the thing is that when you operate in an inefficient market, you have to be open to that inefficiency, which is that you're going to meet random founders who don't fit a paradigm. You can't come into it with like, oh, I only invest in B2B SaaS companies that have X growth and X retention and X whatever. Like, then you just take all this great wonderfulness that just naturally comes in and you throw that away, and you're in this little box. All the money that gets made in this business gets made with things that don't fit in boxes. So I like to think about like Bayesian statistics. In Bayesian statistics, you have your prediction and then you have the base set. I like to invest in things where there's no base set. So it's like, if you're doing SaaS software, the base set is so sophisticated and so cleanly understood by so many people that I literally could give you a business with no name on it. I don't even tell you what they do, but here's a box of metrics, and you could probably underwrite that within 5% in SaaS software, because it's just like, with the right metrics, you can really understand what's going on. Whereas, if you come with this business with no metrics, but with a crazy idea, that's much harder. So that's where I think a lot of the market opportunity is seeing stuff that doesn't have the normative way for the rest of the market to understand, and sort of grabbing that while you can before it becomes clear. And you see that a lot. Like, I invested in a company in December. It was like a 7 million pre, and it was clear they were going to do great, and they had a great founder, and the value was not yet on the chart, but it was clearly going to get on the chart. And then literally it was like 30 million by February and 80 million by this month. And it's just like, because once the value starts showing up on the chart, then anyone can write the check.
That's incredible. I mean, I think you're right. As soon as you have comps, it's something that any quant trader, any algorithmic person can say, well, here's 300 data points that align it here. But when you're skewed very high on the quantitative or on the qualitative side, you end up with being able to use your skill set, which is like, the creativity and the vision combined with the execution that you view with the players. I know we had a little bit of like technical difficulty. I want to be respectful. It's like almost 5. I don't know if you got a hard stop, but just as a quick wrap up, what's kind of the most surprising thing that you found about being a VC that like you didn't expect?
I think one of the most interesting things is that it changes you as a person, because I give away millions of dollars in exchange for pieces of paper that anyone can make. I mean, literally, I could write you a stock purchase agreement and I could hand it to you, and that's easy. Like, here's a piece of paper that I just wrote, give me $1 million. And so that really changes the interpersonal paradigm, and it changes the way that people interact with you, and it changes the way that you then behave, because you're you're constantly kind of getting people pitching you, constantly getting people kind of like coming at you. And yeah, it's like, you know, almost all the VCs I know are kind of weird people, or some of them are kind of broken people. And like now I sort of am like, oh, okay, I understand how that happens. Like you slowly get morphed into a different person because of the way this job works. It's funny, like on Twitter, you know, before, you know, when I was literally at one point, I was one of the world's experts in programmatic advertising. Like, you know, I was there first and I spent all my time thinking about it and I got access to all the information. And I knew more about it than most people in the world, almost anyone. No one gave a shit about what I wrote on Twitter about that. Like, literally, I would get nothing. Now I read a tweet about the fact I think New York is cool and like hundreds of people like it. And that's not because I'm smarter now or I have better insights. It's literally because I give away free money. And so that really changes. It changes things. And I'm still kind of getting used to it. And I don't think I fully understand it yet. But it's an interesting process.